greater than 300%. I mean, just take a second to let that number really sink in. If you're looking for a single metric to understand the absolute tectonic shifts happening in the global infrastructure landscape right now, well, you're looking at it. That staggering figure represents the surge in data center orders for Carrier in the second quarter of 2026. It is an explosive, paradigm-shifting catalyst that is fundamentally rewriting the playbook for a legacy climate-controlled giant.
Welcome to today's Explainer. I am absolutely thrilled to guide you through this material because it's a perfect example of how a singular, massive technological trend, in this case the artificial intelligence and data center boom, can just completely reshape a company's financial realities. Today, we're going to unpack Carrier's Q2 2026 earnings report, and we'll cut right through the noise to show you exactly how this catalyst is creating a ripple effect across their entire global operation.
Okay, let's dive into this. Here is our roadmap for today. We'll start with 1, the data center boom. Move into 2, Q2 financial surprises, explore 3, strategic portfolio shifts, look at a 4, global segment breakdown, and wrap the whole thing up with 5, the future outlook.
All right, starting right off with Section 1, the data center boom, fueling infrastructure. This is the main engine driving our entire narrative today.
You know, when we talk about the digital economy, we tend to think of the cloud as something abstract, right? Almost invisible. But the reality is incredibly physical. The cloud actually means endless rows of server racks processing complex AI workloads, which generates massive, unprecedented amounts of heat. And all that heat requires serious cooling infrastructure. Carrier reported that their global commercial HVAC orders jumped roughly 65% overall. But what actually drove that? It was driven almost entirely by that massive, greater than 300% surge in data center demand we talked about at the top of this explainer. The sheer physical footprint of technological expansion is literally pulling Carrier's commercial business forward at an incredible rate.
So how exactly did that physical infrastructure boom impact the ledger? Let's check out Section 2, Q2 financial surprises, momentum ahead.
This momentum actually caught even the company's own leadership a little bit ahead of schedule. Just look at this statement from Chairman and CEO David Gitlin. He noted, organic sales returned to growth earlier than expected, up 3%, driven by strong performance in our CSA segment. Now, when a CEO explicitly notes that a return to growth happened earlier than expected, it's a huge signal. It points to a macro environment where demand is just completely outstripping their previous conservative forecasts. Let's move to the numbers and see how this builds across the core financial highlights for the quarter. Carrier posted net sales of $6.35 billion, which is a solid 4% increase from the prior year. Adjusted earnings per share came in at 86 cents, and they generated a really robust $810 million in free cash flow. That was heavily supported by $927 million in net cash flows from operating activities. But honestly, the absolutely crucial metric here is that last one. Total backlog has surpassed $8 billion. That's up roughly 40% year over year. That backlog isn't just a number, it's a massive multi-year runway providing incredible visibility and sustained momentum for the company's future revenues.
Now, when you have that kind of financial momentum, management teams have options. That brings us to Section 3, strategic portfolio shifts, optimizing for growth.
Carrier is purposefully shedding its past to fund its future. This quarter, they made it crystal clear they are exiting legacy businesses. They completely exited Riello on July 1st, and they formally announced they're exiting Noresco. By trimming these legacy operations, Carrier is freeing up vital capital and leadership bandwidth. They are essentially clearing the deck so they can focus strictly on forward-looking, intelligent climate investments that align with where the world is going, not where it's been.
Real quick, before we look at where that cleared up capital is going, let's make sure we're on the same page with a key piece of financial jargon. TAM, or Total Addressable Market. Simply put, this is the overall revenue opportunity available if a product achieved 100% market share. It's basically how companies measure the absolute ceiling of a new opportunity.
And this brilliantly illustrates why Carrier announced the acquisition of a company called 75F on July 23rd. Listen, this isn't just about making better air conditioners. It is about embedding agentic AI and cloud-native software directly into intelligent building solutions. 75F gives Carrier access to an estimated $20 billion total addressable market in small to mid-sized building applications. It brings real-time prognostics, self-optimizing capabilities, and even autonomous grid interaction. What this means for the customer is a significantly lower total cost of ownership, way better reliability, and increased energy efficiency. Carrier is quite literally transforming from a traditional hardware provider into an autonomous building solutions ecosystem.
Okay, now that we've seen the high-level strategy, let's see the execution on the ground. Section 4, Global Segment Breakdown, Regional Performance.
Picture a dense urban skyline for a second. Every single one of those high-rises requires incredibly complex heating, cooling, and ventilation, both residential and commercial. But the economic realities of outfitting these buildings vary wildly, depending on what part of the globe you're actually standing in. CARR breaks their business down into 4 distinct global and operational segments to manage all this complexity.
Now, what's really interesting about this slide is how perfectly it captures the nuanced reality of global business. It's almost never just a straight line up, is it? Climate Solutions Americas, their largest segment, at $3.37 billion in sales, saw 4% organic growth. That was driven heavily by residential and light commercial, or RLC, growth, and that was despite some timing-related delivery lags on the commercial side. Europe also grew organically by 3%. But look closely at those other two segments. The Asia-Pacific, Middle East, and Africa segment grew 4% organically, fueled by double-digit growth in India and the Middle East. However, that was partially offset by continued pressure in the Chinese RLC market and lower joint venture income impacted by the ongoing conflict in the Middle East. And finally, Climate Solutions Transportation was completely flat. Why? Because a massive 40% growth in global container shipping was entirely offset by low teens declines in global truck and trailer volumes. It's just a perfect illustration of how diverse a global portfolio really needs to be to maintain overall top-line growth amidst all these regional crosscurrents.
Taking that data center surge and the global performance into account, what exactly does the rest of the year look like? Let's turn to our final section, the future outlook, raising guidance.
So the crucial point here is that CARR is actively rewriting its expectations upward. Their stronger-than-expected first half of the year is quite literally forcing a guidance raise. They previously projected roughly $22 billion in sales for the full year 2026. Well, because of the incredible volume and order backlog we've been discussing, they have bumped that full-year sales guidance by a full $1 billion, up to approximately $23 billion. Consequently, they've also raised their adjusted EPS expectation from $2.80 up to roughly $2.90. This first-half outperformance is rolling directly into a highly confident second-half posture.
And to bring our explainer full circle today, we have to look right back at our original catalyst. As part of this raised guidance, CARR specifically noted they are increasing their full-year 2026 data center sales guidance. They had previously guided for $1.5 billion. They've now raised that specific target to approximately $2 billion. And crucially, they aren't just sitting back, they are already actively expanding manufacturing and lab capacity in the US and India to support the anticipated demand for 2027 and beyond. They are not just riding a wave here, folks, they are building the physical infrastructure to sustain it.
You know, we spend so much time talking about the software side of artificial intelligence, the algorithms, the microchips, the large language models, but every single one of those advancements requires immense physical energy. And managing the byproduct of that energy, which is heat, is rapidly becoming one of the most critical challenges of the 21st century. As these data centers continue to multiply across the globe, it raises a really fascinating question. Will the legacy industrial companies responsible for cooling this infrastructure ultimately become the true, quiet winners of the AI revolution? It's definitely something to think about as you watch this space evolve. Thank you so much for joining me on this explainer. I hope you found this breakdown as absolutely fascinating as I did.